Hello guys, my name is Michael and you are on TRADERSVIEWY channel. And in this video, we will talk about inflationary and deflationary cryptocurrencies and how they differ. I will explain how inflationary and deflationary coins are structured and answer the question, is it true that Bitcoin is actually also subject to hidden inflation, and why does it matter to traders and investors? When choosing an investment strategy, it is important to understand whether a particular coin is subject to inflation or deflation. Knowing this will help us better understand in which direction its price will move. This is especially important when building a long-term investment portfolio. Be sure to watch the video to the end and you will learn why many deflationary coins are actually also subject to inflation and how this affects your earnings. You will also learn which trading strategies are the best suited for different coins. Please write in the comments how much you think cryptocurrency as a whole is subject to inflation. And if it is, how critical is it for a trader or investor? Let's get started. It is commonly believed that cryptocurrency radically differs from regular fiat currency, and not only in terms of centralization, decentralization, convenience, anonymity of use, and various technical innovative solutions like blockchain, smart contracts, data encryption, and so on. It is also believed to be resistant to inflation, or at least it is not subject to it in the same way as fiat currency, but rather differently, as cryptocurrencies are not issued by central banks. Furthermore, their total supply is often programmatically limited, for example, in the case of Bitcoin, 21 million units. Of course, there is also the phenomenon of CBDC, but we will not delve into that today. However, this is just a misconception. In reality, some cryptocurrencies are also subject to inflation. Some coins are inflationary because their supply gradually increases over time, and this supply constantly grows as new coins are introduced to the market. It's somewhat similar to the operation of a printing presses. In general, different cryptocurrencies can be structured in fundamentally different ways. They utilize distinct mechanisms for emitting and distributing new coins to maintain supply and use different systems of economic incentives. Bright examples of deflationary coins are cryptocurrencies with a limited number of coins. They may also have mechanisms for reducing the supply of coins. For example, BNB uses an automatic burning mechanism to reduce the total supply to 100 million BNB. There is also the XRP token for Ripple, of which only 100 billion units were ever issued. There are also coins that change their monetary policy over time. For instance, before the merge, the issuance rate of ETH was usually around 5% per year. The transition to POS reduced the issuance of Ether, and now the coin is considered deflationary. There are also inflationary coins. For example, the 100 billion limit was removed in the meme coin Doge, and currently the influx of new coins is uncapped. On the other hand, it is stable and fixed at a relatively small level, so inflation expressed as a percentage of the total number of coins will actually slightly decrease annually. Another bright example of inflationary coins are certain stable coins. I'm not referring to algorithmic stable coins, which also have many questions surrounding them. Rather, I'm talking about stable coins that are simply backed by reserves in fiat currency. Okay, why does it matter at all? How do these two types of coins differ? Inflationary cryptocurrencies are well suited for spending and regular transactions, for example, as a means of payments. So they have a flexible monetary policy but do not promote saving. Deflationary coins, on the other hand, allow for accumulation, but investors are reluctant to spend them, and the monetary policy over time increases the scarcity of coins. According to Gresham's law, crypto investors will be more likely to spend inflationary coins and hold deflationary coins, like if you value deflationary more than inflationary. And what about Bitcoin? Bitcoin maximalists often claim that Bitcoin has managed to defeat inflation and that Bitcoin is the perfect tool for hedging against the inflation of traditional currencies. But for the sake of a complete picture, let's clarify a few points. On one hand, the maximum possible emission or supply of Bitcoins is known to us. There will be no more than 21 million coins available, the last of which will be mined by around 2,140. Miners also mine fewer coins over time. Bitcoin Bitcoin's economic model includes a halving procedure, meaning a reduction by half in the reward for a new block in the blockchain every 4 years. The rules of the game for miners and investors are absolutely transparent and understandable. This is one of the main differences between Bitcoin and traditional money. Secondly, it is evident that Bitcoin has been constantly increasing in price for many years. Clear rules of the game, limited issuance, and price growth are why many consider Bitcoin a deflationary coin, and it's hard to argue with that. On the other hand, does this mean that Bitcoin is a coin that is truly immune to inflation? It's a bit more complicated than that. Bitcoin can act as both an inflationary and deflationary coin. It depends just on how you look at it. Write in the comments what is your take on Bitcoin's model regarding deflation. Firstly, the supply of Bitcoin does increase all the time. That's a fact. Yes, the emission rate decreases due to halving, undoubtedly, but certainly approximately every 10 minutes, 3.125 new Bitcoins are introduced into the network, meaning there are more coins being created right now, and if the demand for Bitcoins were to increase, we could experience inflation from an economic perspective. Secondly, and perhaps more importantly, it cannot be said that Bitcoin defeats inflation in the short term as a hedge. Bitcoin's market capitalization contains a lot of institutional money. Bitcoin is also heavily dependent on news sentiment. Events like the collapse of FTX can significantly impact its price. In other words, in the short term, it is more of a speculative instrument for many market players. And Bitcoin is also heavily influenced by whether financial regulators are combating inflation or not. Now, it should be noted that news of high inflation usually leads central banks to raise key interest rates. And inflation in fiat is rising and central banks are talking about raising rates. The price of Bitcoin in reaction to the news can actually fall. For example, on June 12th, the US Federal Reserve announced they were keeping their key rate at 5.25 to 5.5, which is high. The main reason was the high inflation that they wanted to combat. When the decision to maintain the rate was made, the Bitcoin price was $70,000. Immediately after that, the Bitcoin price started to decline, reaching $55.5K a month later. Let's consider another example. The two price peaks of Bitcoin in 2021 were reached in April at almost $65K and in November at $69K. By the time, the Fed had lowered the rate to the lowest level since the end of 2015, which was 0.25%. What does this indicate? The low rate boosted the economy and liquidity flowed into the crypto market, including Bitcoin. Therefore, when the economy grew, so did Bitcoin, although traditionally we perceive it to be in opposition to traditional finance. But when the government makes money more expensive and raises rates, investors are less afraid to hold savings in cash deposits in banks or bonds. Hence, liquidity flows from risky assets like cryptocurrencies to fiat. Press like if you follow the news about key rate. What conclusions can be drawn from all of this? Firstly, all cryptocurrencies are indeed different and they use different mechanisms for creating and distributing new coins. Therefore, some cryptos are more inclined towards an inflationary model while others lean towards deflation. Deflationary cryptocurrencies as a hedge against inflation are more suitable for long-term investing. In the short term, they are less effective at the task. On the other hand, inflationary coins are not suitable as a long-term hedge against inflation. However, in short term, during a decline market, they sometimes allow losses to be smoothed out to the level of inflation, preserving a significant portion of savings. Stable coins also perform quite well in this regard. Another important observation is that the choice of entry point for purchasing deflationary coins can greatly depend on whether the Fed is currently combating inflation or not. For example, at the time when Fed lowers rates and induces inflation, buying deflationary coin in the rising crypto market may not be the best idea. On the other hand, when the regulator is curbing inflation and raising rates, liquidity drains from the crypto market, leading to lower prices. This could create an attractive entry point for long-term investments. Of course, this rule is not absolute, but you can certainly consider it for your trading strategies when forming investment. So guys, thank you for watching this video to the end. Don't forget to like, push the notification bell, subscribe. See you next time. Michael was with you today, and bye.